Welcome to the Fund Your Retirement podcast.
If you want to be a longer term investor, it's a good idea to get involved with management with the same sort of long term view.
Yeah.
So a stable management team who own a lot of stock and have done well for shareholders over time. And I like those sort of businesses. And the businesses themselves, these sort of businesses, I look for sort of overlooked ones, so small. So all the companies I own have market caps of less than 500 million, so relatively small. And they do something usually they're obscure or quite dull.
So, quite dull.
Dull, yeah. So
that's how you want your investments to be, isn't it?
Yeah. So things like boiler hire. I look through my companies. Got a list. So boiler hire. One company hires out boilers. Another company makes drills for rock drilling.
Wow.
In commercial lighting, disinfectants, used car finance, that sort of thing. Yeah. So none of it's not glamorous. It's all dull. They're actually these companies make sort of good money, and they can generate decent profit, and they grind out good sort of results generally year in year out without much fanfare.
Hello and welcome to the Fund Your Retirement podcast. I'm Lee Cleesby, the co-founder of Fund Your Retirement. Welcome you back to our weekly insights from our expert guests in finance, business, and wealth building strategies, helping you fund your retirement. Today, I'm delighted to be joined by Maynard Paton, who is a former share tipster and investment writer for the Motley Fool and has been investing in shares for some 25 plus years. He became mortgage-free at 40 and left the 9-to-5 working at age 43. Maynard is here to talk about his investment approach and philosophy, inflation, and how beginner investors can get started building their portfolios. Hello, Maynard. Thank you for joining us today.
Hi, Lee. It's good to talk to you.
Yeah, appreciate you coming on the show. Thank you very much.
I should thank Mark Atkinson. He was on your podcast a few weeks ago, and he suggested I come on and talk to you as well. So, Mark, he seemed to know what he was talking about with investments. So hopefully I will come across as knowing what I talk about as well. So let's see how the conversation goes.
Yeah, brilliant. Thank you, Mark. Really appreciate that. It was a very good suggestion. So actually, when Mark actually pointed out your website, Quality UK Investment Blog, I really enjoyed the articles, especially the FIRE article, which showed your first ever annual salary of just 5,000 a year.
5,000. This was in 1990, so it's a long time ago. But I think in days before the minimum wage. But it sounds frighteningly low. I mean, thankfully, I didn't stay on £5,000 a year.
Agreed.
But I did enjoy a few promotions along the way. But it just shows what can be achieved starting on seemingly low salary. So
true.
With a bit of hard work and a bit of saving and investment, you can even on $5,000 a year, build a decent career and sort of reasonable wealth.
Yeah, fantastic. And again, I encourage anyone to actually go and read that. And I'll put the link in the show notes as well, actually. So if anyone does want to read through it.
Well, I kept that letter thinking it was my first job as some sort of a memento, and this was all pre-internet. So I thought, well, what am I going to do with this? And then I thought, I could publish it on my blog. And I thought, hopefully, it may inspire people to think, okay, I'm in a low paid job. I've just started work. I'm in a low paid job, but but there's opportunities. There's always promotions and way to build your career. So hopefully it may inspire people to sort of to start. Okay, you're starting slow, with low money, but we'll see.
Brilliant. So that leads me on to where I like all the guests to kind of start really and it's their journey, their experience, their 30,000 foot view. So how did you get started in the world of investing, and how has your career developed over these years? How did you go from 5,000 a year to
5,000 a year? Well, I started investing 25 years ago. It's almost 30 years ago, which is a long time now. I started in my early 20s, back in the early 90s, and I've been a keen investor ever since. my early career was in IT, so that's the £5,000 a year job, IT. But I wanted to work full-time in the stock market, and eventually got a job as a financial writer at the Motley Fool, which is a financial website.
Yeah.
I spent 15 years there writing about different shares, different companies, different ways of investing, and was also a share tipster during that time as well. So people would pay Motley Fool for my share tips, which was an experience because it included the banking crash. So 2008.
2008, yeah.
I was recommending shares where there was no shortage of ideas because shares were cheap at the time, but a lot of people weren't interested in taking out subscription because they just lost money all the time on shares. So there's a sort of a mixed feeling at the time. So that was the Motley Fool. So I gave up Motley Fool in 2014. So 15 years there, and I decided to become a full-time investor, blogger, researcher, writer. So I spend my days now writing about shares, the shares I own on my blog. I also do a bit of sort of freelance writing about shares for SharePad, which is a stock market database, a vast stock market database for UK private investors. It has all this data about prices, charts, company fundamentals, all that sort of thing. And I write a few articles for them to help promote their service. So that's the sort of brief journey. I guess in terms of looking back and buying my shares, what got me interested in shares was my stepfather. He owned various sort of blue chip shares, Marks and Spencer, Glaxo, things like that. And I would see him watching the share prices on the teletext. This is all pre-internet, so sort of late 80s, early 90s. And he would be looking at shares on the teletext, and I'd be I just sort of clicked the idea of, I just started working and thinking, well, this seems an easy way to make money. You buy these shares, they go up, and you just don't do anything. You don't have to actually go out and do any work. You just buy these shares, and some of them, the smaller companies, can do really well. You could look at the teletext and say, oh, that share's jumped sort of 50% today. I mean, I could have made so much. That could have made X amount of money doing that in one day rather than going out to work. So that got me interested in shares. And my stepfather said, I remember him saying, over the long term, shares beat cash in the bank. And one thing led to another, and you start reading the Investors Chronicle, again, all sort of pre-internet. So you read in the Investors Chronicle a few tip sheets, and you start getting more interested in the possibilities of, becoming really rich.
That's the initial allure, isn't it?
So I'm on £5,000 a year. And I'm thinking, well, if I can find the next Microsoft, that's me sorted. I don't have to go out to work and program computers. I can sit back and relax. So here I am as a sort of full-time investor, and I'm thinking you can't really relax anyway because I'm working, studying all these shares anyway. So I bought, in my portfolio, it's still a full-time job monitoring a collection of shares. So I'm not sitting back having bought the next Microsoft.
Just sitting back and watching the cash roll in. It's not like that.
It's not like that at all. But as a sort of 20-year-old, you're thinking, you think you don't have that sort of experience of actually things do go wrong in the stock market. You do have to sort of keep an eye on these shares. So that got me interested, and for being a sort of an enthusiastic stock market investor ever since.
So how was your approach and strategy developed then over that 25, almost 30 years from then to where you are now? I mean, how would you best describe your strategy and approach?
I look back and I think there's 3 distinct phases. And I'm in phase 3 at the moment. So I'll talk about phase 3. So you may have heard of GARP investing, so GARP, buying growth at a reasonable price. So I sort of adapted that. So I try and buy respectability at a modest price. So that's the sort of share picking strategy. So by respectability, I'm thinking of looking for respectable companies.
Yeah.
And by respectable people, respectable prospects. So the companies which have got a respectable track record of rising, good record of dividend increases, profit increases, sales increases, that sort of thing, and run by management who care about outside shareholders. So they look after outside shareholders. So maybe they're big shareholders themselves. So they're founder-led companies where the person in charge has founded the business. He sort of lives and breathes the business. He owns a large chunk of stock, and he's treated shareholders well. I'm the small shareholder, hoping for this founder to carry on doing well.
Someone who has a vested interest in actually.
Yeah, you've got a vested interest. Also, family-run firms as well. So the business was maybe set up years ago and has been handed down the generations, and the current generation of the families run it. And these family firms, they do tend to have some quirks, but if they hold a lot of stock, they have a vested interest in the business doing well, and they tend to have a long-term mindset, so they want to pass the business down to the next generation. Which is what I like, you see, because if you want to be a longer-term investor, it's a good idea to get involved with management with the same sort of long-term view. So a stable management team who own a lot of stock and have done well for shareholders over time. And I like those sort of businesses. And the businesses themselves, these sort of businesses, I look for sort of overlooked ones, so small. So all the companies I own have market caps of less than 500 million, so relatively small. And they do something usually they're obscure or quite dull.
So, quite dull.
Dull, yeah. So
that's how you want your investments to be, isn't it? So things like boiler hire. I look through my companies. Got a list. So boiler hire. One company hires out boilers. Another company makes drills for rock drilling. Wow.
In commercial lighting, disinfectants, used car finance, that sort of thing. So none of it's not glamorous, it's all dull. They're actually these companies make sort of good money, and they can generate decent profit, and they grind out good sort of results generally year in, year out without much fanfare. And very occasionally, because they're dull and because some of the ownership structure is quite quirky, sometimes the market is not really interested, and you can pick these companies out the share prices at quite modest valuations, and they can just do well over time as companies grow and more people sort of latch onto what's the sort of the progress they've made. So it's not very exciting, but I've seen enough exciting shares that have done really well and then done really badly. So I quite like the sort of peaceful life, really.
How long are you holding these for then? Do you have a time frame, or is it just until something changes within the company or the sector?
I own 11 shares and I've held all of them for 5 years or more. And I think 5 of them I've held for 10 years. So it's a long time. Some of them I should have sold some time ago. But I think most of them, I'm quite happy with the progress of most of them. Some of them have not done as well as I thought. But in terms of selling, it's generally when even the management change. So either the founder steps down, something like that, or the company's going to get disrupted. Some sort of competition comes in, that sort of thing, where the product, the service is just going to get
something changes,
disrupted, and the competitive advantage or whatever is disappearing. So that's the main reason to sell. I think so. I tend not to. My selling is pretty bad. I think I tend not to sell. I tend to hold on longer sometimes than I should. But a lot of the time in the last few years, it's been wrong to sell because you think, the share price can't go any higher. It's so highly valued. And then you sell, and
it keeps grinding up.
keeps going up. So it's been, some of the shares I've held, still a bit. I bought one share at something less than 50p, started selling it at 70, and it got up to, £6.
Oh,
you think Okay, so it's come back down to 3, but you think, well, it's been wrong to sell. It was wrong to sell.
Yeah.
So,
nobody has a crystal ball, do they?
No. It's always, I think, certainly in conditions like as the last sort of, for smaller companies in the last 6 to 9 months, a lot of people are thinking, I should have sold. Yeah. When the shares were riding high, and at the moment it's pretty sort of, a lot of investors are a little bit despondent looking at what they could have sold at just a few months ago, really.
Yeah, as you mentioned on our pre-chat that although the indices are quite high, that the smaller stocks have actually suffered, haven't they?
Yeah,
because they're piling into the bigger blue chips, aren't they? The larger investors.
Yeah, so the FTSE 100 is just remarkably resilient over the last 2 years or so. I think ever since the sort of vaccine sort of announcement back in November 2020, all of a sudden, the growth strategies of the previous 10 years have all sort of faltered, and the FTSE 100 is loaded up with all these value shares such as miners, banks, and all the rest of it, which have done nothing for the previous 10 years, but all of a sudden they've sparked into life. And just about everybody who's involved in growth shares or small cap UK shares certainly have just underperformed the FTSE 100 over the last sort of 6 to 9 months, especially. Certainly this year, first 3-4 months of this year has just been pretty terrible for your typical private investors in smaller companies. So, and the FTSE 100, this so-called dinosaur index, has been marching along, or at least holding its own, and making a lot of people look a bit questioning how they're investing. And you could actually see it continuing, because these sort of trends do last for longer than people expect. So you think about the banking crash and the emergency base rates. I mean, we're still on low base rates 13 or 14 years after the banking crash, and you think, well, how long is the current environment going to last for? I mean, I don't know. But so a lot of people are saying, well, look how we've done over the last 10 years. I mean, this is just a blip for value and all the rest of it, but I don't know. So we'll see what happens. So ultimately, it's about the companies that you own, how they perform. So if they perform well, then it doesn't matter what the indices are doing. If they perform badly, then that's something else.
Do you hold international stocks, or is it just purely UK?
It's all UK.
All UK.
Some of the shares I own, they have operations overseas, but it's all UK shares. I mean, you look at the American shares. A lot of American shares have done really well. And you think, should I be investing in the States? That sort of thing. And I'll tell you a story at the Motley Fool, because it's owned by an American company. And every so often they'd send over the American analysts over to the UK to work. And one time, this was years ago, one of them was going to recommend writing about Tesco. He's going to recommend Tesco for one of the tip sheets we were running. And I casually asked him, what do you think about Lidl and Aldi? These discounters starting to sort of encroach on Tesco. Tesco was riding high at the time. And I got the firm impression he did not know anything about Lidl and Aldi. He didn't have the sort of local knowledge of us Brits. And I just think, if I'm going involved in American shares or foreign European shares or anything like that, I don't have the local knowledge. It puts me at a disadvantage. So I like to think I've got some sort of advantage here in the UK. And if other people want to invest in international shares and leave UK shares to the likes of me, then that's fine.
That's fine, So you're in phase 3. So you've described pretty extensively how you approach your investment style, but you wouldn't actually, we said on a pre-podcast chat, you wouldn't recommend anybody to start where you are. So let's go back to when you were in phase 1. If someone's listening right now at where you were at the beginning of your journey, how would you say to them to get started, to build, so they can build their portfolio? Because the markets have changed a lot since then as well, haven't they? There's a lot more different options and vehicles to achieve somewhere close to what you've achieved in your journey.
There's more choice. So So for me, it was all individual shares. I mean, I didn't know anything about trackers as such. I mean, they weren't promoted as much at the time. So I would recommend, to be honest, I recommend the normal, or for most people, a tracker is fine. A global tracker, equity tracker, something like the Vanguard tracker, something like that.
It just tracks the major global indexes.
The global equities, and that's fine. For most people, you put your money in every month and do something.
Like a direct debit, just straight over.
Yeah, do something every month, and then you can concentrate on your life and your work and your family, that sort of thing. Forget about the stock market. Do something more constructive than looking at share prices every day.
Yeah.
I think, and over time, most people putting money in a tracker, they should do well, relatively well versus stock pickers, because much as we like to think I'm trying to find the next Microsoft, that sort of thing, doesn't really work out like that. And you tend to, buy high and sell low. Yeah. That's the risk.
The psychological
shares are going up, you buy high, and then, oh no, they start going down as they are now. And you think, you become despondent, become depressed, and then you give up selling it right down at the wrong time.
Yeah.
But with your tracker investor who's trying to build up wealth over the years, so even if the market goes down, they're still investing. They're probably not even thinking about what the market's doing other things, building a career, family, that sort of stuff. Yeah. And you just ride out the downturns. And the thing about a tracker every month is you're guaranteed to buy the market at the low within 2 weeks of the low. You see what I mean? Yeah. So you're still investing. That's where all the money's made. If you look at any sort of stock price chart, all the money's made if you buy low. Yeah. When it recovers. So the tracker investor, bang, 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 you're investing all the time through the bottom. And that's where the money's made. If you're investing in individual shares, you may have given up by then.
Well, you described a great example earlier of you set up a pension, didn't you, for your son, who I think at the time was 2, and you set that up in 2007, if I'm correct.
No, it was 2003. He was born.
2003. Sorry,
2005. I set it up, and
that was a great example of how to demonstrate pound cost averaging through the financial crash.
Yeah, so set it up in 2005. He was 2 years old, and I put it into a FTSE 100 tracker. I mean, which perhaps in hindsight wasn't the best investment, but I was restricted because I was working on a tip sheet, so I couldn't invest in individual shares at the time. Right. So I put it into the FTSE 100, and if somebody told me, okay, within 3 years there's going to be a banking crash, shares are going to collapse 40% in 2008, I thought, well, okay, I'm not going to invest. But I didn't know that, so I put money in every month. Sure enough, the banking crash happens, and I'm still putting money in every month, and I'm not thinking about these monthly payments. They're just going in. Yeah. And 10 years later, I look at the value of the portfolio, and it's done all right. You think you've had this massive crash, but the value of the portfolio is up. And based on what versus contributions I put in. And you look at the FTSE 100, I think it's been sort of broadly flat over that time, but the returns were positive because I was investing down at the bottom of the banking crash.
Every month, just buying the index.
Yeah, so you can read about pound cost averaging in books and blogs and all the rest of it, but actually doing it in practice and looking at the rewards and thinking, oh yeah, I invested all through that. I must have bought within 2 weeks at the bottom of the crash, and he thinks, oh yeah, it works. Yeah, it works. And so you think, so that's the advice. That's my advice for most people, is actually don't bother with individual shares because they take a lot of time and a lot of risk unless you're really into it and I've got the time and skill and inclination to get involved. A simple global tracker will, over the long term, you will beat most private investors because you'll stick with it. Yeah, it's just very simple. Yeah. Most private investors, I think, are too busy buying high and selling low. And I say, I'm guilty as anyone of doing that. So yeah, that's straightforward. It's not groundbreaking advice. That is
No.
a suggestion. It's all quite simple, and people may
Yeah.
think, well, I want something better than that. But over time,
Most people want the next Microsoft, don't
they don't want the next Microsoft, but they're very hard to find.
Yeah.
So over time, you will win out. 30 years. I dread to think, could I have just done better in an index tracker rather than my shares? I don't know. I don't work it out. But
well, I've looked at your portfolio on your website. Probably not. I think you've done okay.
Yeah, but I mean, I should have just bought Microsoft back in the 90s, and so. But for me, just for not most people, just monthly payments into tracker to build up your wealth over time.
Yeah. I would like to stress as well, by the way, that this isn't actually a recommendation. We're just having a conversation. There's no advice being given here. Please go and see a regulated advisor before making any decisions. Just sharing some quality information here. So yeah, that's a disclaimer away. No, that's brilliant. So two really gems there actually. Want to point it out in case the audience didn't catch it. You set up a pension for your son when he was 2, so you're really setting him up to really be financially secure later on in life.
So this is an article I wrote for the Motley Fool after I set it up. Was My Son the Millionaire?
Yeah.
So the power of compounding in the stock market. You think because the early years really count. So if you start investing early, you've got the pot there to compound up in the later years. It gets harder. All the maths show that it gets harder. If you start investing at 40, it's harder to get the same sort of pot if you start investing at 20 or 2.
Yeah.
So he's got a good start, I think. And the idea is that he may not need to contribute into a pension when he starts working. Because it will compound up over time. So he's got another 40 years before he reaches 60, whatever. So over that 40 years, hopefully that'll build up into a nice sort of pot.
Yeah, you think so. Yeah.
Well, hopefully, maybe he will become a millionaire when he's 60. I just hope I'm around to see it.
Yeah.
When I'll be 80 something or other.
He can then take care of you then, can't he?
Yeah. Yeah. So it'd be fascinating to see how it turns out. We all talk about long-term investing and all the rest of it.
That is the ultimate long-term, isn't it? Started at 2.
Started at 2, and just see how this pot develops. It should be fascinating to see how it all works out.
So over your so first of all, that's phase 1. Then get started there, because as you've said, you spend most of your time now monitoring your portfolio. So there is, to get to where you are now, there's a lot of experience, a lot of time, isn't there? And I'm sure you've seen multiple crashes over the years. And most people's fears of the stock market is when we see the media presenting the constant narrative that the financial system is going to end, the stock market's going to go down. There's a constant stream of negative media around the financial markets and the economy. How do you deal with that as a seasoned investor? How have you, over the years, when you've gone through the financial crisis with your stock portfolio, you've gone through this taper tantrum of 2013 and then COVID, and also the war in Ukraine that we're experiencing now. How have you dealt with that psychologically?
You've got to know your companies. You've got to know why you hold the companies that you do. So understanding how the companies make money is a good start. I mean, it sounds really simple, but are the customers likely to still be customers, still pay for the goods and services of the companies that you own during whatever events occur, whatever
situation's going on? Makes sense.
So understanding the companies, understanding the management. How did management cope in the pandemic, let's say, or how did they cope during the banking crash, let's say? Have they put money aside on the balance sheet for a rainy day? Because that's something I look for in my companies. Is there more cash than debt, let's say? If something untoward happens,
so they can weather the storm type thing.
Exactly. So they've got cash on the side. So during the pandemic, also people thought, what's going on? How can we survive? And the companies that survived, prospered, had cash set aside for a rainy day, and that's down to the management. So you look at what the business does, and it's just about understanding the companies. Now, some companies will do badly. If we are in for a recession or a tough sort of economy, there will be some companies that suffer, and you've got to work out, my company's going to suffer. What do they do? What do they do? Do they have too many liabilities? Do I trust the management to cope with the current situation?
Yeah.
And so that's one part.
Yeah.
You've got also the psychology of falling share prices. So we all love it when share prices go up.
Yeah.
Great. Look how much money I've made. And then the emotion goes 180 degrees. When the share prices go down, you think,
yeah, what's going on?
It's the emotional effect. All the paper losses have gone. I can't start, there's gloomy news coming out. And you think, that's it, enough, and sell. Yeah. And that's just the wrong time to sell.
Usually that's the bottom, isn't it?
That's the bottom. So people capitulate is the word, where they give up.
Yeah.
And that's the bottom, and the market sort of rebounds strongly afterwards. So it's just a case of managing if you understand your companies, you can manage your emotions a bit better. You can understand that actually people are still going, let's say, to Tesco and buying their food. The food may cost a bit more, and the cost of, but Tesco will still be around. Giving it a sort of like a broad example, but you've got to understand your companies, and the more you understand them and the people who run them and the sort of the finances of the business, the more likely to think, actually, I'll stick with this.
Yeah.
Rather than panic sell at the bottom.
I suppose a good example for that at the moment would be the inflation rates that we're experiencing is strangling people's surplus cash. So what are people cancelling? Netflix. But
it's all the discretionary
spending, isn't it? Yeah.
So you think, so the UK consumer looks to be heading for a tough time. Gas prices, electricity prices, all the rest of it.
Yeah.
You look at the statements coming out of from the stock market, from different companies through the stock market each morning, and there's always a profit warning, some sort of warning about higher costs, lower sales, profits aren't going to be as great as we expected, that sort of thing. So it's a bit rough. So you've got to make a judgment on the companies you own, and what they do, what they sell, and whether the customers are going to come back. Netflix. You read, there's an article on the BBC about Netflix, and all the comments saying, "Well, I pay for Netflix, but I share the expense with my mum and the neighbour and that sort of thing, all the passwords," and think, "Well, I'm not going to pay it. I'm going to give up now if they're going to charge me for that." So you can get a sense of the mood for certain companies from online, that sort of thing. The point you make about the media is a good one, because is at Motley Fool, I was writing articles and was the editor at the time, and all during the banking crash and the sort of follow-on sort of Euro crisis, Greek crisis, and all of that. Page views go through the roof when you write negative articles. So anything about Greece going bust, Northern Rock going bust, all that sort of thing, the page views go through the roof, because two sorts of people are thinking, panic, I've got to sell, or this is a buying opportunity, that sort of thing. So they want to read the news, and it's volatile share prices, especially downward volatile share prices. It's just the interest. So it's the media. So the job of the media is not really to make you money as a private investor. They're not there to help you make money.
No, they want your attention.
Yeah, they want clicks. So the editor behind the website, he's thinking, I need more clicks, that can generate me more adverts, income, that sort of thing.
Yeah,
he's not bothered about your portfolio returns. And from someone who's worked on the other side, I understand all that, because I was focused on clicks and all that sort of stuff, and people signing up for emails and that sort of. So I can look at headlines and articles and think, I know what you're writing about. I know what your sort of agenda.
Presenting, yeah. Unfortunately, the saying is negativity sells, doesn't it?
It does.
That's unfortunate.
Yeah, it's great, and I've seen it. I've seen all the stats at Motley Fool where the page views just they skyrocket. So it's unfortunate, but you got to switch all that off and look at what your companies are saying. So if you look at the stock market announcements every morning, just see what they're saying. And some companies are actually doing all right. They're not really a problem, that sort of thing. So I guess
that's getting back to knowing your companies, isn't it? As you said, and that's where the time and effort comes into being a stock picker, as opposed to, say, buying the index.
Yeah, you've got to manage, certainly with smaller companies, which is where I specialize, and you've got to sort of keep an eye on them, because you never know, even with the best sort of management and finances and the best sort of business, you never know what's around the corner, that sort of thing. So you've got to keep an eye on them. But yeah, it involves a bit of work. It's quite in-depth work, and looking at the sort of the nuances of some companies, because bad news tends to be sort of, sometimes it comes out of the blue, but a lot of the time it's already in the small print in the company statements and that sort of thing. What the companies don't tell you.
Yeah.
Where you've got to sort of like dig down and think, oh, well, actually, this doesn't look great. The number of times where there were signs in the accounts that things aren't going correct. Yeah. And sort of like 2 or 3 years later, the whole thing blows up.
Yeah. So I'm guessing, given the current kind of inflation rates that we're experiencing, if I'm presuming here that you've actually already stress tested your portfolio in this type of environment, the stocks that you hold, and that's how you kind of manage yourself through what we're experiencing at the moment.
I certainly reviewed my stocks during the pandemic. So the first, March 2020, I did an emergency portfolio review, thinking, can these businesses survive? I mean, I didn't know what was happening. So you're reliant on the balance sheets. They've got some cash. They've got cash, no debt, and the management teams have been there a long time, and they had large amounts of stock. So their interests were aligned with mine, because presumably they didn't want to see their sort of life's work go down the drain as well. And
customers are still going to need what they were offering as well.
Yeah. So I mean, I own shares in a restaurant chain, which suffered.
In the pandemic,
it already suffered pre-pandemic. So when the pandemic comes along, that's just the last thing it needed then. But for the others, they performed pretty much all right. I mean, 1 or 2 of them cut their dividends, but by and large, they did okay. Yeah. They all survived. I didn't need, as a shareholder, to pump more money into them. A lot of companies, they had to raise more money because they hadn't put money away for a rainy day. They'd all been spent. So at least I didn't have to sort of rescue some of my investments.
Yeah. So I'm going to change track now then, if that's all right with you, because we've covered, I think that's been a really insightful conversation of how you analyze and assess stocks and your portfolio, but also how someone can get started as well. So obviously the other big topic that we see quite often in the media is cryptos and NFTs, digital assets. Do you have any thoughts or opinions on those?
I don't know. So 3 important words I think any investor can say is, I don't know. Yeah. So on crypto, NFTs, all that sort of thing, I don't know. It just keeps you out of, so admitting that keeps you out of trouble, basically, of getting involved in something which you don't really know much about. And, it just gives you an opportunity to lose money. Yeah. So, I mean, there's all sorts of asset classes you can get involved in. So Bitcoin or bonds or commodities, that sort of thing. And you think, what do I know about these asset classes? So I know about small cap UK shares, and I still get things wrong, but I focus on that sort of area. And I like to think that I've got an edge in that sort of area because I focus on it. You develop a sort of knowledge about that sort of asset class and how to make money from it. So with Bitcoin, something like that, I think there's something with the blockchain technology. I think there's probably something to it. But as an asset class, I don't know.
Yeah. Which is a great insight there in itself, isn't it? Because what you've just demonstrated to myself and up for the audience, that you focus on the area that you know, your area of
your area of competence. So Warren Buffett calls it circle of competence. You don't stray out, and every time you sort of stray out, you go off the beaten path. There's a greater chance of losing money. So the idea of investment is try not to lose money. So with Bitcoin, I mean, it sounds great. Everyone's involved in it. I'll give you another story. I went to the dentist the other month, and went with my son, and we were talking about him going to university. And she said, "What do you do?" And I said, "Well, I'm a financial sort of writer."
Yeah.
"Oh, do you know anything about Bitcoin?" So my dentist is involved in Bitcoin, and said, "Do you know anything about NFTs?" I said, No. Luckily, she said she does put into an S&P tracker.
Yeah.
So, but she said her friend he owns 11 Bitcoin.
Right.
So quickly did the sums and thought, well, he's got £400,000 in Bitcoin. So no wonder she's interested in Bitcoin. Yeah. So he bought all these Bitcoins years ago.
Yeah.
And he's clearly made a lot of money. And so my dentist is involved, and I'm thinking, right, okay, maybe if my dentist is talking to me about Bitcoin, I should not be invested in Bitcoin, but I don't know.
That's usually the warning signs, isn't it? So yeah. Maynard, I mean, it's been a great conversation. If we come to the end of the podcast, I've just got one more question. What book, if you had one book to recommend, what would it be for the audience to pick up and read?
This is a tough one. I think my favorite...
two then.
No. I've whittled it down to one. So my favorite is One Up on Wall Street by Peter Lynch. Peter Lynch, yeah. So this was written, I think, about late 80s, 1990, something like that. So it's an old book. It's American, but it's just, the way it's written is just fantastic. It's quite funny. Brilliant. It's very readable even for a sort of amateur investor or someone who just doesn't know anything, not familiar with investing. So very readable, very funny. He talks about looking for the next 10-bagger stock, sort of the next Microsoft, that sort of thing.
Yeah.
And he looks for dull, just like me, dull companies doing something a bit dull, overlooked, small, just grind out good results and hope, then the market sort of catches on and they go up 10 times. At least that's the theory. So it's a very entertaining book, and it's very, very readable, and it tells you all about all the foibles of private investing, where you buy high and sell low. Yeah. And you've got to get into the mindset of, this is what Peter Lynch sort of stresses in the book, where you got to think, actually, I'm a buyer when the shares are down, and I don't want to sell. I want to sell high and buy low, which is, I recognize, is difficult to do, but Peter Lynch tries to stress that in the book. So it's a very entertaining book. Brilliant.
No, there you go. Another good recommendation there. So where can the audience connect with you, or where can they follow you? Would you share a little about your blog and also your newsletter that would be beneficial?
So I'm at maynardpaton.com. So everything about me is on that website. If you want to stay in touch, you can just pop in your email address onto my website, and I send out an occasional newsletter. Yeah. So every so often you'll get links to what I've written about on my blog and my sort of SharePad articles as well.
Brilliant. And I will make sure those links are in the show notes. So if you scroll down, if you're watching or listening, the links to Maynard's website and that FIRE article I mentioned will be there. And check it out. Thank you very much, Maynard. Really enjoyed it.
Yeah, it's great talking to you, Lee. Thank you.
Cheers. Thanks. Bye. I hope you enjoyed the video, and if you haven't subscribed yet, go ahead and subscribe to our YouTube channel. And you don't have to stop there either. We have more videos on the screen for you and lots more insightful content on our channel and at our website, fundyourretirement.com. I want to thank you very much for your time, and I'll see you in the next video. Bye for now.